With me now is Jayakumar of Prime Securities. He always has his pulse on the market and on this auspicious occasion of Diwali. So thank you so much for joining our viewers. Firstly, wishing you and your family a very, very happy Diwali.
And the viewers, thank you. I think that's the most important, the backbone of every channel, as it were.
Right. Absolutely. So, let's first start with the markets. It's been a long while we had a chat with you. Can you just tell us that, what's changed in the last 2 years for India? Why India suddenly on every decline is seeing buying?
Well, actually, I think India has always been a country where bottoms up has been a pretty exciting theme for at least a lot of us who believed in sort of kicking the tires and getting our feet wet, as it were, in terms of the research process. And I think that's been an exciting market. I think what's changed is this entire, should I say, putting India on the world stage, which this government has done. Not the least of the reasons being this kind of international travel schedule that, of a frenetic pace that the Prime Minister has started off, which in times of trouble has, obviously been, stands us in good stead, because everybody now knows that there is a government which is keen to do all the sort of good things, as it were, and, welcome overseas investments. And in times like this, where literally people are hunting around for areas to get yields, returns, or actually make equity investments, clearly India is there. So I think in addition to the bottoms up, which always was there, and it was to that extent seasonal, this time you also had a top down, which is just allocation of money. And the first flush of money which has been allocated is happening as we speak, which is why literally at every decline you have ETF money coming through, allocating itself, and to some extent, therefore, increasing or stretching valuations. But people want that exposure, and therefore it's coming.
Right. These are very uncertain times if you're in a global market. Say you were in Europe where yields are negative as a fund manager.
Sure.
What would you do? Would you just invest in India? At least the dividend yield is sufficient enough?
I don't think it's as straightforward as somebody not investing in Europe and coming here. I think it starts off pretty much more macro than that, which is out of their global pool of capital, as it were, people allocate, let's say, an X amount to emerging markets. Now, hopefully in the emerging markets, India is not just getting a percentage, but more and more people in the emerging markets for a while have been allocating a little extra to China, let's say, or an extra to a few markets. I think India is today getting that extra allocation almost on a consistent basis. So within the emerging markets, which is, in almost all portfolios an integral part, India is more than an integral part in that. But I'm not too sure if we can draw the conclusion that people will invest in India regardless. I think there are challenges, but a lot of that has been overcome in recent times. And clearly, maybe the Indian diaspora at one level, but more than that, it's just that India has been there on everyone's lips. And I think that's...
See, you've been in this market for a very, very long time. Now, if you look at 2008 to now, the returns have been hardly anything, especially on the index. And when you make it dollar returns, it's been even lesser.
Sure.
Would that be the correct way to look at it, that the returns have not been that great so far?
Well, I think the way I would look at it is every country must start off by saying who are their principal investors. You can't depend only on foreign flows. And I think the healthy thing that's happened over the last few years is the re-emergence of the domestic investor. And from his perspective, whether dollar returns are X or Y is not that relevant. But as long as he's able to get a fair mix of diversified stocks, which he can invest either through mutual funds or portfolio management schemes or specific fund managers, I think he's happy. And I think the big success of the market this time has been that it's not that all boats have risen in a rising tide, but actually very good quality stocks. And in fact, the discerning part of this rally is that in each sector, there are as many stocks hitting, there are more stocks hitting new lows than necessarily new highs. And therefore, it's only the differentiated winners which are... So good quality, as I said, PMS and mutual fund schemes are being, are good avenues for people. And I think the fact that they have generated good positive returns and the fund managers are positive about, the near future, as it were, along with, let us say, FII flows that keep coming in, I think means that literally not just that every decline will be a buy, but I think that we could consistently keep outperforming global markets and global peers in the emerging space. I would definitely say for some length of time.
Right. So between 2006 to 2008, a lot of retail money came directly. But now, as you're pointing out, that it's coming via the SIPs, via portfolio managers.
And therefore less people have been burnt in this process. Because in 2008, if you remember, people took a long while to come back because 5-6 years retail just stayed away. And every time the market went to 6,000, 6,200 on the Nifty, retail was selling. And that for the first time changed with the Modi government, where we decisively crossed 6,400 and then made a new base at 68, 6,900.
Right. Just recently, we've, till about 4 months back, it was all about private banks, retail-focused banks.
Sure.
But now things are changing. We saw a big deal happening. We saw a big RCOM deal happening. I know you cannot talk about stocks, but do you think corporate banks, the focus on companies where debt can be written off, would be the next big theme?
See, there's an entire theme on restructuring. And, we as a firm actually are pretty much into pure advisory, which has been a big shift, as it were. That it's pure advisory on restructuring, M&A, rebalancing of, corporate portfolios in terms of, divestitures, etc. So from that perspective, the way we see it, it's a very interesting concept, I think, which, viewers would do, well to sort of listen to. Most people tend to look at PE multiples for a long time. Really, the way you need to look at it is look at the operating performance and the EBITDA. Most industries have a certain multiple on EBITDA. Consumer and FMCG tend to have very high multiples because they're very low on debt. But manufacturing and other turnaround cases, typically even if they're at 7 to 10 multiples on EV by EBITDA, so the EBITDA multiple generates an enterprise value. And if you see in the restructuring cases, most of the enterprise value, which is nothing but equity, there's market cap plus debt, that debt tends to take up a very high percentage of the EV. So typical restructuring cases, without going through specifics, would be 5,000 crores enterprise value, 4,800 crores debt, 200 to 500 crores equity value. Now, take a scenario where enterprise value remains roughly the same. If out of the 4,500 crores debt, which is obviously too high for the EBITDA to pay. So typically a 5,000 crore debt would mean, a 5,000 crore EV would mean that EBITDA would be in the range of 5 to 700 crores. Now, how can 5 to 700 crores EBITDA support a 4,500 crore debt? So if you have to write down debt based on some of the RBI nomenclatures, or whether you call it S4A, which is the
new norms,
the deep restructuring through banks, or the SDR, or through a straight CDR, or whatever other restructuring mode, if debt on a present value basis can come down, let's say from 4.5 to say 2.5 or 3,000 crores, which is not unheard of in cases like this, the incremental 1,500 or 1,800 crores of debt written off potentially can go to add on to the equity value, which, by the way, you're only starting at 200 or 300 crores. So if 200-300 crores can suddenly go up to 2,000 crores, you're talking about a 10 bagger on equity. And it's not intuitive to most people that in a restructuring case. So there's a famous case of a auto ancillary forgings company which is trying to sell off its foreign assets. Again, I don't want to name. This is North India based, and in fact based all over India. They got multiple assets all around the world. Every single asset sale can effectively shave off 1/3 to half of their debt. And their equity value is a fraction of the enterprise value.
Right. A lot of concerns about people for such assets have been that, once the asset is sold off, the best assets gets the best value, so the best EBITDA is also going away. How would you factor in for that, or how would you identify these ideas?
The way to look at that is, in most cases, people have started off by saying the company is dead.
Right.
So really, you start off by saying equity should be worth 0. Now, instead of 0, if it or close to 0, you suddenly add 500 or 1,000 crores. It becomes the first wave. Now, the moment that happens, you are able to use that as currency to actually either expand or bring in new businesses. And the good thing is that it's not that too many businesses have acquired junk. Yes, some businesses have gone out and acquired expensive assets or at wrong times. But I think the big problem has been that businesses have been acquired principally on debt with very little equity. That's been the birth and the genesis of crony capitalism. That you acquired and expanded capacities and acquired capacities through virtually no equity, virtually on bank money.
Right.
Now, at some point in time, these values have gone up either because of real estate or because of the depreciation of the rupee, etc. So these assets are valuable. But when you junk these assets, it gives you a one-time adrenaline kind of impact, which cannot be ignored. Now, if these are decent managements which have an intent to pay back banks, most banks are saying, fine, you can pay us back in 8 to 10 years, but you know what? We want money in the next 2 years. Take a haircut, give us the money. And that's the practicality of the banking system, where the private sector or now even public sector, which I think is giving rise to this arbitrage between the market value of equity and what should be the equity value. I think restructuring is going to be, to my mind, especially because the low-hanging fruit in the market has disappeared. So restructuring is going to be, to my mind, the next big, for want of a better phrase, the next white bread, if you will, for the markets.
Right. Till now, Jakes, it's very interesting that, till now, we've seen big deals in cement.
Sure.
We've seen big deals in assets, very few assets, not all across the infrastructure space. So you think infra, shipping, where there is a lot of debt, that's the space where these deals would now happen?
I would say, put it differently. There's a famous case of a diversified shipping company which sacked its when I say sacked, means just eliminated its Singapore subsidiary for $1. But in the process, they saved 1,000 crores of debt. I mean, they got rid of 1,000 crores and a recurring loss of 300-400 crores a year. Now that company is profitable everywhere else, and the moment you knock this off, equity valuations from being almost close to zero become seriously non-zero numbers. Or for instance, cement. Now, there's again this diversified cement major, where the problem is if you start cherry picking, or rather the acquirer starts cherry picking your assets, you could end in a scenario that you're only left with junk. But if you're able to do what I would call surgical cuts to your debt as a result of a restructuring scheme, the results can be fantastic. Unfortunately, one is conflicted in not talking about stocks, but more importantly, not conflicted from a professional perspective, because some of these are our clients as well. But I think the important thing to realize here is that people think in terms of equity as equity alone. Very few people think in terms of equity and debt together. And I think the big arbitrage also in terms of a knowledge perspective is that a lot of upside is there in the markets embedded in business plans and restructuring, which the public does not see immediately, but experienced fund managers ought to.
Right. What do you think, as far as the corporate banks are concerned? You mentioned about the asset owners would be a player. Would banks be a players as well? Would bank be a good player as well on this?
See, banks, I would say banks that can actually, it's been seen over a period of time that banks who don't take hits are not able to move. So a lot of the PSU banks today are attempting to solve these problems, or rather put it differently, recognize these problems first and resolve later. To quote Chanda Kochar, for instance, she says, not just recognition, but resolution is equally important. I think most of the PSU banks are at the first stage of even recognizing that there's a problem. Moment you recognize, in the past you've not, for a variety of reasons, you also needed capital to recognize problems, but the resolution is the challenging part. So I don't think PSU banks are in a position to resolve these issues. I mean, they can at best sell off to an ARC. In one or two cases, they may be able to acquire the shareholding and then flip it around. We haven't seen even one such case. So I think resolution is a bigger issue altogether. But I think the very job of recognizing itself, but because they've been paralyzed with balance sheets stuck and unable to recognize and indeed resolve, they've not been able to move forward because there's not enough money to grow. Now that growth, for that matter, whether in the housing space or any in the retail space, has been taken up by these NBFCs and microfinance companies. So people keep asking why the multiples in the NBFC space in terms of multiples to book, etc., have gone up even beyond what private banks are able to do. The beauty is that private banks are restricted in what they can do. NBFCs are a lot less restricted and therefore are taking up a lot of slack of the lending or the growth, as it were, in the credit markets, which should have been logically filled in by either PSU banks or otherwise, is being taken up by the NBFCs, which is why the multiples and the growth in the near future happen to be there.
You've been one of the persons who've identified sectors which people don't talk about, and then you even exit them when people talk about something like a Aban offshore, which you've done earlier, something like a rice company, which you have done earlier. Can you just tell us what's the thought process behind exit? We've had a lot of people who say how to identify stocks, but when do you decide to exit any good stock?
See, what happens is stocks go through this phase of complete ignorance to completely being ignored to first level coverage. And then if there is scalability, so take the case of Aban, for instance, classic case. People didn't know about it, it was generating cash, had expansion plans in mind, went about acquiring companies. And actually Aban, from a portfolio perspective for us, grew 80x. from identification, and ultimate exit was at about 50 or 55x, I remember. And the identification was only because the leverage just ballooned out of shape, and the reluctance to deleverage through equity issuance was the trigger which we used finally to exit. It is not so much, I would say, that. So you exit typically when there's an information overdose. You exit when there's a huge jump in multiples without corresponding management action or without corresponding intent of management action. Should I say some such thing like that? Or the environment is unable to bring in equity at the pace that you want it to. Aban was a case of that. So Aban's actually now a global industry. It was in its infancy in India when we identified. Or for that matter, this rice company out of Chandigarh, which became 20x on our portfolio before we exited, or 15x or whatever before we exited. And one needs to be equally happy about the exits as the entries, as it were. Again, we exited because I think a lot of, need to dilute was being talked about at a stage when they didn't need the cash flow. So when a company dilutes when you don't need cash flow, we realize that that's when the equity returns will start tapering off. So you need to have some of these things, because ultimately what happens is internal generation, debt and internal accruals, if that's the driver of growth, you'll see growth being, equity returns being disproportionate. And at some points in time where there's an overdose of equity or a greater dilution without corresponding growth, you know that the equity can only be an overhang, it can't be a value accretive proposition.
Right. Right now one would say that things have changed for the aviation space. So we've had a very good acquisition of SpiceJet where things have changed. We've had a great listing of Interglobe Aviation.
Right.
Prices are stable. Jet is trying to come out of its own problem. It's seen a FDI. Is that a sector which is at a cusp of the growth?
We think again the sector is, but even out of those three stocks or more if they list, we think there'll be stocks hitting new lows while other stocks will attempt to scale new highs, even in that space. Because I think some of the key elements in that space are cost. So you need to have extreme competitiveness, because at the end of the day, whether you fly an Indigo or a SpiceJet, there are very few discerning people who say, I only want to fly business in jet and nothing else.
Right.
So the mass consumer, if you will, ultimately will be driven by definitely service, on time, etc., being part of it. But more importantly, cost and the frugality of some of the services, if you will. So we think high load factors and low on cost, that's going to be the yardstick. And I think if a decent expansion in routes keeps happening, I think your growth is well taken care of. Flying overseas routes or overseas sectors is not necessarily the way for profitability. So we like one company in that, and I think you need to go down to see that if these parameters are met, which of the companies fits the bill.
No, but again, this is a sector which you were saying people just hated. They did not want to buy.
Sure.
Then it has grown. We've seen numbers now looking good. So it's going through that phase where people would get attracted to this sector?
I think money is coming in. There's no question about it. There's coverage on this space. There are people coming in, and there are people coming in and burning their hands as well. Because not all companies are going linearly, right?
Right.
Because they're oil price related as well. You've got to take a call on that. You've got to take a call on the management. And their focus on, as I said, specifics. As we speak now, there's a price war going on, as prices have been brought in by one of the leading players in the industry. But how people address some of these things, so 2, 3, 4, 6 quarters of results will, I think, create the base for good stock picking in this.
Right. DVR is also something which you have liked. There are a few DVRs, 4-5 companies have listed their DVRs. Sure. Assuming if you like one of the companies, how should a retail investor approach a DVR?
The DVR at the end of the day is nothing but an instrument that gives you slightly higher dividend, but more importantly, it prevents or takes away from you the right to vote. Now you need to look back and say that for the companies that are listed, and there are 3 or 4 DVRs in the market, some of these are top quality groups that have issued these DVRs. That for the joy of not being able to vote, will you settle for a 35 to 40% discount? I mean, the answer has to be a table thumping yes.
Right.
That if somebody told me that you get the same economic benefit, other than in the case of a takeover, where people will want the voting shares. Otherwise, the DVR, most parts of the world, in the US, for instance, companies like Google, etc., which have their DVRs listed, trade at a 1.5% differential. In Brazil, there are 3 or 4 DVRs listed, and the equivalent of the non-voting share. They trade between a 1.5% premium and a 7% discount. So for India to be specific and unique and say we're going to trade at 35 to 45% discount makes no sense.
Right. And again, I was just looking at a lot of sell-side reports. So a lot of reports are there on Jain Irrigation, on Tata Motors, on Pantaloon. But on DVR, when you just talk, the coverage itself is low. Any particular reason?
Well, one of these DVRs is in the index as well. So what coverage do we want to talk about? So the fact of the matter is, when people talk about the stock, it's assumed they're talking about the DVR as well. But right. The irrationality of a 35 to 40% discount is not known today. Put it differently, can that 35 become 45? I don't think so. Can 35 go down to 15? I think it should logically go down to 5% discount.
But it'll take some time.
Actually, when cost of holding these stocks and the returns that the debt markets are giving is so low, it shouldn't take time. Logically, I can argue, but who am I to, sort of question what's happening? But I think if you ask me, that's an irrationality that's waiting to be grabbed.
Right. Apart from that, one sector that you would be bullish on is also the shipping space. Now, considering the prices are not that great,
I don't think shipping. I would say port related. I wouldn't say shipping as such.
Right. So port related services.
Because a lot of activity. See, first of all, what happens policy level? There's huge activity on ports, and port related services, whether it's dredging, port related services, other maritime services related to ports, maybe in terms of coastal shipping. These logically will have to explode into action, because they are linked to ports. And since the pure play on ports, there are a few only, but we think the port services are ignored, and therefore, see, our theme is ultimately you've got to grab spaces and companies that are ignored first, because that's where the value proposition, and if you believe those managements are willing to expand, willing to grow, that becomes a second order derivative where you can actually feed off from.
Right. Any other sector apart from this, what we have discussed, where you're bullish on? You may not be bullish on the stocks in the sector, but they can lead the earnings.
So I think one of the spaces we really like is, with this entire consumerism, etc., the mall culture. So we think one of the derivatives of that, because the sort of retail spaces are pretty expensive. One of the derivatives of that is packaging. And we think anything to do with packaging, and typically these are BOPP packaging. Most of these are plastic films. We think one or two companies in that space are hugely undervalued. The space itself, by the way, trades at 6 or 7 times EV by EBITDA multiples. It can easily be re-rated 30, 40, 50%. And spaces within that, the efficient guys are even trading lower than that. So that's an opportunity, the BOPP packaging, which could become, pretty interesting.
I had seen this BOPP packaging in 2008-9 when it was actually doing very well. And again, the similar talks were happening. But suddenly you started to see their earnings falling, because of prices of crude. Is that a big risk?
No, that's because most of them have been so far commodity linked. And they've been pure commodity players. So when the price of crude go down, they pass on the entire benefit, in fact more. When it goes up, they're not able to pass on the entire cost to the consumers, because most of the consumers are big FMCG players. But here you need to look at those who are 30 to 40% in specialty. Most of them don't do any specialty packaging products. Now, if you go into specialty films, that's where the margins are not the 7s and 8%, but could be up to 20, 25%, because there are huge value adds, where there's a fair amount of research, fair amount of time to market that happens, and a concept that has to be. For instance, there's now a BOP packaging for cement, for instance. There's BOP packaging for, films for solar films. Now, those are specialty applications of BOPP, which were not there earlier. Now, those will not be entirely correlatable with oil prices. And therefore, in the specialty space, or those who are in the specialty space can actually command a much higher multiple than they do so today.
Just as you said, just wanted to ask about the real estate pack as well. Now, it was one of the sectors which had huge debt till 2008, but fantastic returns. Then we saw the 7-8 years of problem which came in for the real estate space. Do you think a lot of companies have learned the way to go ahead? It's not just acquiring land by debt, and that could be an interesting play with rates coming down?
Well, I think what you need to do is every market needs to, in some sense, get a clearing price at which volumes transact. The problem about the space today is the immobility. I mean, real estate was meant to be sticky assets, if you will, but inventory that doesn't move, but at most times would move at some price. But if you're not willing to bring down prices at which inventory moves, then you will have stickiness of inventory and therefore a balance sheet that's paralyzed. I think that the trick here is to forget what the valuations were. I mean, stocks are down 90 to 85, 80% from peak levels. Most stocks. I think the trick here is that to identify markets where at some price. So for instance, I'll give you an example, Nariman Point, at a certain lease rental came down to a 30% occupancy level. Today, Nariman Point is probably at a 65-70% occupancy level, where literally there's transparency that monthly lease rentals are, let's say, 175 to 180 for not so great buildings, 180 to 200 for good buildings, and there's volumes getting transacted, at least the leasing market. Moment you say there's something on the leasing market, it translates into the ownership market, where at the 150 rupees a square foot, rates might have been in the range of 25,000 rupees a foot, goes up to 200, it may go up to 35,000. So there is some correlation. Now you may still say that a 6% or 7% yield on real estate is low, but to the extent it is 6 or 7%, there's at least volumes at a particular price. So in most residential spaces, I don't think we have that clarity. So take Gurgaon for instance, which is multiple project, multiple names. Prices range from, I would argue, from 8,000 rupees a foot to 25,000 rupees a foot. Now that can't be a feasible range at which volumes take place. So you've got to come down to a stage where people say, margins are adequate, I'm ultimately a converter, but at least I'm able to get rid of my inventory at a price. And I think the price determination is very critical.
Right. Just to sum it up for our viewers, can you just say, if anybody is wanting to learn how to research, he's heard this interaction, gone on to sectors, what are the basic checks that one should do before investing into any company? It may be for any sector. What are the basic checks?
I think if you ask me today, many of the financial sites have actually a lot in terms of message boards, in terms of analyst comments, in terms of research reports, in terms of media coverage. That has to be your first level of calling. And if you don't want to go down that, just put your money with good quality mutual fund managers and portfolio managers. That's it. That's the way to do it.
Right. Thank you so much, Mr. Jayakumar. It was a pleasure.
Thank you. Thank you. And all the very best to your viewers as well.
Thank you.